Hello and welcome again to Beast Buddies. Today we learn how to start investing in 2023, a guide for beginners but with very helpful information. And stay to the end of this video for being a profitable investor. To be a good investor, you need first to choose a strategy to get started. Investing depending on the amount you invest, the time frames for your financial goals, and the level of the risk that makes sense for you. How much money do I need? How do I get started? And what are the best investment methods for beginner? Are just a few of the queries. Here is what you should know to start investing. 1. Start your investments as soon as you can. One of the best ways to get good returns of your money is to invest when you're young. Thanks to compound profits, your investment returns now begin to generate their own return. Your account balance might accumulate over time thanks to compounding. At the same time, a lot of people ponder whether they can start off with not much cash. Simply put, yes. Due to low or no investment minimums, zero cost, and fractional shares, investing with smaller sums of money is now easier than ever. Many investments, including mutual funds, exchange-traded funds, and index funds, are readily available for relatively small sums. 2. Decide how much to invest. Your financial status, your investment goal, and the deadline for achieving it all will determine how much you should invest. Retirement is a typical investment objective. As a general rule, you should try to invest 10 to 15% of your annual income towards retirement. That undoubtedly sounds impossible right now, but you may begin small and gradually work your way up to it. Your first investing milestone is simple if your employer offers matching funds for retirement accounts. Simply make a minimum contribution to the account to qualify for the full match. You don't want to lose out on that free money, especially when your company match counts toward that objective. 3. Pick an investment strategy. Your investing strategy is based on the amount of money you need to save in order to attain your goals, as well as your time frame. Almost all your assets can be invested in equities if your goal is something like retirement, which is more than 20 years away. Yet, selecting individual companies can be difficult and time-consuming. For this reason, for majority of investors, the ideal approach to invest in stocks is through investing stock mutual funds, index funds, or ETFs. The risk involved with stocks makes it better to keep your money safe in your online saving account, cash management account, or low-risk investment portfolio. If you are saving for a short-term objective and you'll need the money in less than 5 years, here we list the top choices for making quick savings. You can open an investing account with Robo-Advisor, an investment management firm that builds and manages your investment portfolio using computer algorithms if you are unable to make a decision. Low-cost ETFs and index funds make up a substantial portion of the portfolios created by robo-advisors. Robots allow you to get started quickly because they have low price and low or no minimums. For portfolio management, they demand a nominal fee of typically 0.25% of your account balance. 4. Understand your investment options. You must choose what to invest in after deciding how to do so. Every investment involves some level of risk, so it's critical to comprehend each one, its level of risk, and whether or not it's aligned with your goals. For those who are just starting out, the most common investments include stocks. A stock is a unit of ownership in our particular business. Equities are another name for stocks. Stocks are bought for a share price, which, depending on the company, can range from a few dollars to several thousand. We advise you buying stocks through mutual funds, which we'll go into more depth about below. Bonds. A bond is essentially a loan to a business or government organization that promises to repay you over a specific period of time. You receive interest in the interim. Generally speaking, bonds are less risky than stocks, since you know exactly when and how much you will be paid back. Bonds should, however, only make up a modest portion of your long-term investing portfolio because of their poor long-term returns. A mutual fund. A mutual fund is a collection of investments that have been bonded. Investor can buy a variety of stocks and bonds in one transaction through mutual funds, saving them the time and effort of selecting individual securities. Mutual funds are inherently more diversified than individual equities, making them generally less risky. While some mutual funds are professionally managed, index funds, a subset of mutual funds, track the performance of particular stock market index, such as the S&P 500. Index funds are able to charge cheaper fees than actively managed mutual funds because they do not require expert management. Exchange trade funds. Like a mutual fund, an ETF holds many individual investments bundled together. The difference is that ETFs trade to the day like a stock and are purchased for a share price. An ETF share price is often lower than a minimum investment required of a mutual fund, which makes ETFs a good option for new investors or small budgets. Index funds can also be ETFs. Thanks for watching. We hope this beginner guide on how to start investing in 2023 has been helpful. Remember, investing is a powerful tool for building wealth over time, and the key is to start small, stay disciplined, and be patient. Keep learning and exploring your options, and don't be afraid to take the first step towards your financial future. Good luck!